A warm welcome to you, my dear children. We meet again with the next session of unit number 5. Unit 5. In this session, we are going to discuss how transactions affect the accounting equation. How transactions affect how they affect the accounting equation. And in the previous session, we discussed about the same thing, how transactions affect the accounting equation, but with simple transactions, right? You might remember we took 3 examples which are given in the textbook, and we discussed how those transactions affect the accounting equation, how assets, liabilities and equity change due to the transactions. The students who got together, who were with me in the previous session, you remember everything. But for the students who are watching this session for the first time, without watching the previous session, I'll try to make it clear how transactions, how they increase and decrease assets and liabilities in equity of a business. But it's better if you watch the previous session before coming to this session. Start with this business. Whose business is it? Yeah, it's Nehara's business. Nehara's business. Nehara started a business to repair computers. Well, probably this Nehara must be a lady. Yeah, obviously. It's not a boy's name, right? Nehara started a business. This lady has started a business, okay, to repair computers. She must be a computer technician. She has started a business organization with her skill and knowledge to repair computers, And you are the accountant of that business. I have mentioned this several times, children. When we are doing accounting, we are not owners of the business. No, we are not owners. We are accountants. As accountants, from the point of view of an accountant, we should look at these transactions. All right, let's get it on. Following transactions are given to you for the first month of the business. First transaction. I'll move to this side so it's clear to you. First transaction, children. Invested 500,000 as capital. The same transaction we did in the previous session. In those example transactions, the first transaction was owner invested 800,000 to the business to start the business. That was the previous exercise, previous example we did. This transaction is exactly the same. Owner investing 500,000 as the capital. Capital is brought in by the owner of a business, and we are not owners, we are accountants. So when the owner invests money to the business, we get that money. Owner brings in and puts in cash, we get the cash, right? And we might, it's up to us to keep the cash in the cash till or in a safe of the business, or we can deposit the cash in our bank account in the business bank account. Take this 500,000, 5 lakhs, go and deposit in the bank account. Easy, right? Safe. Or if you prefer, if the owner advises us to keep the money in the cash till, we can keep the money in the cash till. Whatever. We get cash from the owner. Cash, 5 lakhs. That means in the business, into the business, cash asset flows in. So cash increases, isn't it? In the business, there were no cash. Now we have 5 lakhs cash. So all of a sudden, cash increases by 500,000, and equity also increases. Why? Why? Because the owner brought in that 500,000 and it is owner's equity. All right. First transaction, we are getting it on the board right now. First transaction. First transaction comes here. And do you notice how this table is arranged? You will also get a similar question in your monthly test papers, in your term test papers, maybe in the exam paper too. You will probably get this type of an accounting equation question in the exam. There's a probability. If you get this type of a question, children, in the exam paper, they might provide a table similar to this. In the paper itself, they might provide. They might say, use the accounting equation as shown below to record these transactions. Saying that, they could give a similar table on the paper itself. If the paper has not given you a fixed table to record these transactions, you must draw a similar table. That's why I mention it here. I wanted to mention it here. Can you see the assets? Can you see the equity and liabilities? This is the accounting equation, right? Assets equals equity plus liabilities. Assets equals equity plus liabilities. This is the accounting equation. All right. Under the accounting equation, under this accounting equation, do you see how assets are divided into 3? You must also draw a similar table to record this type of a transaction set. To record a set of transactions, you need a table like this. I'm talking about an exam question, children. In an exam, in a term test, in a monthly test, in a examination, if you get a set of transactions. Can you? Well, first of all, to divide the assets into columns, you must know what assets you have. You must know what assets you have, isn't it? To know what assets you have, you must go through the examination question before doing it. You must go through the question. Go through means read out the question. Read out the question very carefully. Invested 500,000 as capital. Okay, now you think, okay, capital comes to the business. That means owner has brought in money. All right. So money comes to the business, right? That means cash increase. That means cash asset should be there. Cash asset should be there. See? Cash asset. Next, obtain a bank loan. Now you think, bank loan. Bank loan is a liability. It's a liability. Which means under liabilities, you should have a separate column for bank loan. One of the main liabilities. Under liabilities, you should have a column for likewise children, you should decide on how assets and liabilities should be categorized. Okay, going further down, deposited 100,000 in a fixed deposit. Oh, fixed deposit, that means fixed deposit means FD, right? There is an FD in this question. That means it is an asset. Bingo! There is a separate column for FD. Separate column for cash. Separate column for equipments. Further down, there must be equipments too. See? Purchased equipments. That is another asset. So you should have a separate column, a column for that asset. The equipment, fixed deposit, cash column, all under assets. You got it? All right. Moving on. Now, let's start with the first transaction. Invested 500,000. Cash 500,000 comes into the business. Cash 500,000 comes into the business. We are in the business. We say, thank you, Miss Nehara. Thank you, madam. And we use that cash to start the business. Okay? Owner is a separate person. Business is a separate unit. We are in the business. Our point of view is not the owner's point of view. In that case, investing cash 500,000 means it's not our money, it's the owner's money. Comes to us. We are the business. In the business, cash increases because of the 500,000 which is coming in. In cash column, 500,000 increase. 500,000 increase. First transaction. Again, under equity, also 500,000 increase because this 500,000 was brought in by the owner. And owner's money is mentioned under equity. Okay, owner brought it or whoever brought it, it's a cash income, cash incoming, cash inflow to the business. Then it must be under cash because it is an asset. It must be under assets and it must be under equity too. Did you get the point, children? Must be under cash, under assets, and must be under equity too. 500,000 cash invested by the owner. There you go. We have two entries properly recorded. make sure that you have 2 entries for every transaction, double entries for every transaction. For this transaction we have 1, and we have 2 entries. Done. Moving on to the second transaction. Obtained a bank loan. We get money again, cash again, 200,000. Earlier it was 500,000. Now it is 200,000, but not from the owner. This time we are getting cash from a bank. It's a loan. It's not equity, it's a liability. Which means due to this transaction, second, again we get cash, no doubt about that, we get cash. So cash increase, under assets cash increase, plus, just like the previous transaction also, it was a plus. This transaction 200,000, again plus, because we get cash from the owner or from a bank loan, it doesn't matter. Cash comes in, so it's an asset increase. But this time, because it's a bank loan, liability increase. Liability increase by 200,000. We get a loan which was not there before, a liability which was not in the business before. Now we have, which means it's a increasement of liabilities in the business. Okay, second transaction. We are moving on further down. Let's finish it off. Third transaction. Deposited 100,000 in a fixed deposit. Again, now we are not getting money from anyone. Like we got 500,000 from the owner, like we got 200,000 from a bank. Now we are not getting money from anybody. We are sending money which we have into the bank. Deposited 100,000 which we had at hand in a fixed deposit. Deposited 100,000 in a fixed deposit. Fixed deposits, children, FDs. Fixed deposits are assets. They are assets. That means although money which we have at hand, although 100,000 of money goes out of the business, that goes to a bank account which is a FD. Which is an FD. First of all, we must record that money which is going out. We are doing the third one, right? Yeah. Money which is going out. Okay. We are doing the third one, right? Third one, yeah. This one. 100,000 FD. Depositing 100,000 in FD. Third one. First recording the money which is going out. Cash decreases. Cash decreases. But FDs are assets too. And we have a separate column for FDs. That FD asset increases. Before we did not have an FD for our business. Now we have an FD of 100,000. So it is an increasement of an asset. Increasement of an asset in the business. Increasement. Yeah. Right. Third one also done. Moving on to the fourth. Earned a cash income 60,000 from computer repairs. Earned a cash income. Nehara must have gone and provided a service to a company or an office. She's a technician. Remember? Oh, you almost forgot. right? Nehara, she's a technician. Nehara, technician, okay? She's repairing computers. What she has done is she has earned a cash income. She has gone to an office or a company or anywhere where her service was needed, and she has provided a service, and she has earned a cash income of 60,000. Money coming in, more money coming into the business, but not Nehara's personal money. It's not her capital. If her capital was invested, definitely equity should increase. Definitely equity should increase. But she is not bringing in her own money and investing to the business. She is going and earning an income. Let's see how incomes are recorded. Let's see how incomes are recorded quickly. We are in the fourth transaction, and fourth transaction is a special one. It is an income. It is an income. 60,000 increasing of cash is obviously recorded, that we already know. 60,000 increasement of cash, because cash coming in to the business. Cash coming into the business. 60,000 cash. Now more money, more than we had before, we have now. That means cash has increased 60,000 because it was brought, 60,000 was brought by an income. But see how the equity also has increased. See how equity also has increased by 60,000. Why is that? I told you this is not owner's personal money. Owner is not investing. Nehara is not bringing in cash and investing to the business. If Nehara brought in her own personal money, that is owner's investment, and owner's investment is going under her equity. But this is an income, not equity. How come the income 60,000 also it has gone under equity? How come? What do you think, children? You son, what do you think? Why is this 60,000 here? Children, incomes are like profits. Income is not profit, okay? Incomes are like profits. Financial benefits or inflows of cash which increases profits. More incomes we have, more incomes we have, more incomes we have, more incomes we have, more profits there will be in our business. So profits belong to the owner. In that case, when incomes increase, profit increase, so incomes also go to the owner, go to the owner's equity. Okay? I'm not saying that incomes should be taken by the owner. Income is not taken by the owner. Income comes to the business. But incomes ultimately result in profits, and profits belong to the owner. In that case, children, when incomes are received in the business, cash, that income amount 60,000 is mentioned as an increasement of cash. At the same time, it is mentioned as an increasement of equity. All right, a lot of lines drawn. Now it's clear. Okay, that is that. End of story. Incomes increase capital. Last one on this slide, fifth one. Paid 10,000 as monthly rent. Oh, what's that? In the previous, this one we had an income. In this one we had an income, children. But in this one, we are having an expense. Paid, that is an expense. 10,000 as monthly rent. The cash we have, we are paying for various expenses. Various expenses, children. There are various expenses, number of expenses. It could be rent, it could be insurance, it could be salaries, it could be electricity bills, water bills. The list goes on. Various expenses are there. When money is spent for expenses, cash goes out. So cash decreases. Fifth transaction, cash decreases. At the same time, it decreases equity. If incomes increase, profits, expenses decrease profit. That's why it decreases equity. Something that owner should get, it is decreased because it is spent. Clear? Fifth transaction, it's an expense. I'm going to write these things for your reference. You should note these things and bear in mind, because these things are important for your examination questions if you get this type of a question. Marks. These are marks. Don't lose them. Expenses. Fourth transaction, we have income. So fourth, I will write income. Yeah, this one. Fifth transaction, fifth one, we had an expense, decreasing capital. Is that clear, children? Let's move on. Nehara withdrew 20,000 from the business for her personal use, private use. This is called a drawing. This is a drawing. Owners come into the business and taking money from the cash till, from the cash we have, they are taking money whenever they want. It's not a good thing. It's not a good thing, children. But we can't say no because they are the owners. They just walk into the business, count the cash, which is in the till, which is in the cashier, cash at hand, and they say, Mr. Ranasinghe, I need 20,000 today for something personal. Okay, take the 20,000, but madam, remember, this 20,000 will be deducted from your capital. That's what we should say, children. Remember, owners' cash drawings or taking cash for their personal use, every single time we must, as well as deducting it from the cash, we must deduct it from the capital too. So remember, children, drawings decrease capital. Drawings decrease capital, as well as cash, it decreases capital. Sixth done, we are down to seventh. Purchased equipments, again 100,000 goes out, but 100,000 worth of equipments come in. That means 100,000 equipment. This column is for equipments. Okay, 100,000 equipments coming in, 100,000 cash going out. That is the seventh transaction. Eighth transaction, paid 5,000 of the telephone bill. Expense. I'm not going to tell you that expenses decreases capital. Oh, I told you. Again, expenses, children, decreases capital. Okay, so paid rupees 5,000 of the telephone bill, it is here, it is an expense. It is an expense. Expenses decrease capital. That's why 8th transaction, cash going out 5,000, because we paid out a telephone bill of 5,000, cash went out of the business, so cash decreased. At the same time, expenses decrease capital. 9th transaction, Nehara invested an additional capital. Like I said, this time Nehara is bringing in cash to the business, and we are inside the business, we are accountants, we get cash, we are happy. Well, it's not an income, it's a cash inflow. Incomes are different, cash inflows, well, cash income is an inflow too. Okay, but there are other types of inflows. You will learn these things soon. Capital investing or additional capital investing is not an income, it is an other type of inflow. But same thing, both increases capital. 9th transaction, Nehara invested additional capital, so money coming in 50,000, which means cash increase and equity increase. Finishing off with the last transaction, settled 20,000 of the bank loan. We took a bank loan, can you remember? Here, where is it? Here, yes, the bank loan. We took a bank loan of 200,000. Must settle, right? But not the entire bank loan. In this transaction, we are settling only 20,000. A small amount we have paid to settle the bank loan. Cash decreases because cash going out, we are paying to the bank, and the liability also decreased by 20,000. End of story. Children, what you should notice, what you should keep in mind is every single transaction must have 2 entries. The point you should notice here, the point you should bear in mind, 2 entries, double entries. Let's see whether we have double entries. Yeah, I'm sure we have double entries. Yeah, 10th transaction we have double entries, 1, 2. 9th, 1, 2. 8th, double entries done. 7th, double entries. Where is the double? Oh, it's here. Double entries. Did we tick the 6th? 6th also double entries. 5th, Where is the fifth? It's here. Double entries. Fourth double entry is there. Third one also a double entry is there. Second double entry is there, and first we have already ticked. Isn't it fun? Well, you too will think that it's fun when you get along with these type of exercises. When you're comfortable, when you're confident. It's a fun activity, children, and you can earn marks in the examination because you will probably get this type of a question in your exam paper. Shall we? What's next? More exercises. We'll finish it off in 5 minutes. Now we are gaining confidence, we are having more knowledge, we are having more practice. Practice makes you perfect. Let's practice. First transaction. We pay a creditor 310 by check. We pay a creditor 310 by check. That is the transaction. How to record this transaction? Here, how to record. We pay a creditor means, isn't our money, business cash going out? Business cash going out, so cash decreases. Under assets, cash decreases. Minus mark. How much? 310. Okay? Because there are no separate columns for cash, I will write cash here. Isn't it clear to you? If it's not clear, I will use a different color. 310 decreases cash. But because it's a creditor, children, creditors are people or suppliers that we are owing. Because it's a creditor, it's a liability. The business is owing for the goods we bought. We haven't paid. So that supplier is a creditor. If we pay them the amount that we are owing, the liability is gone. That liability is gone. We are settling that amount, which goes under liabilities, and liabilities also decrease. Creditor. All right. Did you understand how it's done? How it was done? Second transaction. Second. Bought fixtures 175 paying in cash. Bought fixtures 175 paying in cash. What does it mean? We have paid cash, so cash goes out, but fixtures come into the business. One asset decreases, but the other asset, because it's coming, new fixtures, the business fixtures increases. So one asset decreases, the other asset increases. Which asset decreases? Cash asset decreases. That means under assets, I have to write minus cash. Cash asset decreases. At the same time, children, because more fixtures are bought, fixtures asset increases. I have very limited space, so I will write fixtures under assets itself. we should have separate columns, right? Should have separate columns. Fixtures asset increases. I will write fixtures. Fixtures. Right, so that's that. Second transaction, both effects, both entries went under assets. But in the first transaction, one entry under assets, one entry under liabilities. Yeah, I hope it's clear to you, children. Fixtures increase, but cash decrease. Next one. Next one. What does it say? Bought goods on credit. Bought goods on credit. Bought goods on credit. 630. 630. Bought goods means we are buying goods for our shop, for our showroom, or for our boutique. We are buying goods, but we are not paying on credit. Cash? No, not paid. On credit. You know, in Sinhala we say ණයට ගන්නවා. So goods come into the business, goods increase, but cash doesn't decrease. You don't pay now. It creates a liability. So to that guy who provided, who supplied us the goods, we are owing. We are owing him now, right? No need to do that. We say, all right, Mr. Give us 1 week. We will pay the amount in a week. Until that, we owe him. Which means, children, goods increase because we get new goods. We get new goods. So goods increase. Goods are assets. Goods are assets. We can say goods, we can say stock, whatever is. We can say goods, we can say stock, whatever is correct. But cash does not decrease. Cash is not paid. Cash is not paid. That creates a liability, which means this transaction, because of this transaction, stock assets increase, but liability also increase. So I have to write here plus creditor, plus credit. All right, I hope it's clear to you. It says credit. Plus credit. We'll finish it off. Now, with your practice, do this exercise along with me, children. Next one, the proprietor introduces another 1,200 as cash. Zoom කරලා ගන්න. හැම transaction එකක්ම මම underline කරනකොට zoom කරලා ගන්න. Proprietor introduces another 1,200 cash into the business. Cash coming into the business. So under assets, cash increase. Under assets, cash increase. Cash coming in, right? Cash asset increase plus cash. And this cash we got from the owner. Owner's equity. Owner brought, which means equity increase under capital. Equity increase under capital. E. J. Walker lends the business 2,500 in cash. That is a person, maybe a lender, you know, ණයට දෙන Poly යට දෙන those people, we borrow money from a lender. His name is J. Walker. Mr. J. Walker, from him we borrow cash. Liability, right? Cash increase, liability increase. Under asset, cash increase. Under liability, liability increase. All right, next one. A debtor pays us 50 in cash. Debtor means the people who owe us, they are owing us, they have to pay us, because maybe they have borrowed money from us, or maybe they have bought goods from our business. Without paying, they have taken the goods. You know, debtors. Debtors are assets. Debtors are assets. Until they pay us that money, until we get the money, we have to stay firm. Madam, you owe us, you have an amount to pay, you took a packet of milk powder and sugar and biscuits for your kids last week, remember? Pay us, pay that amount, please settle that amount, huh? Stay firm. Stay firm. You can't forget your debtors. They owe you money. Debtors are assets. But when the debtor pays that amount of money, we don't have that debtor anymore. That means debtors decrease. Under assets, debtors decrease. Yeah. But at the same time, the debtor brings in money to the business, so now we are having more money. We got money, which means cash increase. Cash increase. Very little space we have, right? Yeah. But in an examination paper, children, most of the time with these type of transactions, you get a table. Not like this. You get a bigger table to record these effects. All right. This is a quick exercise. That's why this format is used. Last one. We return goods costing 90 to a supplier whose bill we had not paid. I'll move to this side so it's clear to you. We return goods costing 90 to a supplier whose bill we had not paid. Children, the goods that we buy, the goods we buy for our shop. If they are expired, if they are not suitable, we can return. Returning goods means it's decreasing of goods, right? But that supplier, when we bought the goods, that supplier, to him we have not paid. His bill we have not settled. But we have taken the goods, we have brought the goods. Now that the goods are expired, we are returning the goods. Okay, so goods decrease because goods are returned. Goods decrease. Goods are assets, so under assets, goods decrease. We can say goods or we can say stock. Stock decrease when we return the goods we bought. But at the same time, children, because liabilities, because the creditors, the suppliers, we are owing them, they become our liabilities. That also decrease because we return the goods back to them. Under liabilities, creditors decrease. Creditors. Under liabilities, creditors decrease. All right. Finally, we have this last transaction. Bought an office computer paying by check. Office computer. We have bought a computer for the use of the business, and we have paid 610 in cash, which means, children, this transaction also affects assets. 610 cash goes out, but a computer comes into the business. Minus cash under assets, but plus a computer, because we got a computer. Plus computer. There we go, children. Some quick transactions, a quick exercise. You have more set of transactions here. Do by yourself. If I do the same thing here, that will be my efforts. That will be my effort. No, you try to do these transactions on your own, alone. Have more practice. Practice will make you perfect. So with that, children, recording business transactions and effects of transactions under the accounting equation. We are coming to an end to this part. A little bit more in Unit 5 is left and will be discussed in the next session. Get together for our next video and we'll finish off lesson number 5, Unit 5, that is accounting equation. Thank you very much for being with me. See you soon.